The next section we're going to talk about is the 3 weeks tight pattern. This is an area where you're typically pyramiding into a position that you already have. Occasionally, you'll use this 3 weeks tight pattern to initiate a brand new position, but that's not really ideal. The way we identify a 3 weeks tight pattern is by looking on a weekly chart. You want to look at the closing values. They should be very tight, almost unchanged, within about 1.5% of each close. So you start off at the first week. Is the next week within 1.5%? And then you also look for the following week. So if all three of those are really almost unchanged, staying within that 1.5% band, then we would call it 3 weeks tight. You can also have 4 weeks tight. When you get beyond that, you're kind of dealing with a stock that really should have already moved at that point. But occasionally we will notice 5 weeks or more tight. So when you're looking at the weekly chart, your job is to identify, is this tight? Does it look constructive? This is a formation that we'll see within bases. But what we're talking about right now is something that has happened outside of a base where you're going to be looking to add to an existing position. Once you've identified the 3 weeks tight pattern on a weekly chart, you want to toggle over to a daily chart. That's where you're going to look for the precise buy point. So the first example we're going to look at is NationStar Holdings, symbol NSM, here recently. Let's start with the weekly chart. You can see that it came out of an IPO base, had a nice move up for about 4 weeks, and then started holding in tight. You can see some wide swings intra-week, but by the time Friday rolled around, it closed almost unchanged. The first week was down a little bit, the next week was up a little bit, but those closing values, they didn't really go anywhere. The way I like to interpret looking at a 3 weeks tight is the stock has had a move up and is not giving up much ground, and it's staying at the same value. This is a sign that the stock is under accumulation. The sellers are coming in, they can't push the stock down much, the buyers step up, and they're accumulating the shares at that point. Now, eventually, it'll either move up or it'll move down. So our goal is to wait and make sure that the stock is going to move up. So we have identified this 3 weeks tight pattern on the weekly chart of NSM. Now we're going to move over to the daily chart, and we're going to see exactly where we're going to start buying this. So when you look at the daily chart of NSM, you can see how important it is that we started with a weekly chart. Because if you're just looking at this area just shy of $20, it doesn't look like it's tight at all. In fact, it looks very loose. That's why we start with a weekly chart, seeing where those Friday closes are, those values that are almost unchanged. Here, when you're looking at the daily, you want to see where is that area of resistance. Clearly, it went up to $20.36 and then backed away, fell down to $17. So the $17.18, that's kind of our support area, and the $20.36 is our resistance area. But as you can see, the week before it started moving higher, kind of had a nice little downtrend. So what I would do is I'd draw a little line there and see once it pokes up above that downtrend line, that's really starting to clear the area of resistance. So as it starts clearing that area, I'd start my buying, and then if I have a lot of shares to buy, I would finish it up as it goes into new high ground at $20.36. So you don't always have to wait until it really goes all the way into new high ground. You can get a little head start if you can see an area of resistance. Many times it's a horizontal line. In this case, it happens to be a downtrend that it's breaking. About 19.5 or so is where I'd start buying, and I'd finish up my buying right as it goes through $20.36 into new high ground. And you can see it does exactly what you'd expect it to. It runs up in a straight line. That's the type of action you'd like to see out of a 3 weeks tight. So going back to the beginning of this, ideally, you would have had your original position as it broke out of its IPO base right around $15, then sat with it as it moved up to $20.36 and just watched it go back and forth, not selling, not buying any shares until it established that 3 weeks tight pattern. At that point, you're adding to it as it goes through 1950 all the way through 2036, accumulating shares in that area. Keep in mind, you don't want to run your original cost basis up too high, so you're not going to buy the same amount of shares that you bought at 15. So if you bought 1,000 shares breaking out around 15, maybe you'd only buy 300 or 400 shares as it was moving through the $19 and $20 price range. So this was NSM, NationStar, back in July of 2012. Next up is Chipotle Mexican Grill, CMG. This stock has a lot of interesting things to talk about. We're going to focus on the 3 weeks tight and the 4 weeks tight over on the right side of the chart. Now keep in mind the stock had tons of overhead over on the left-hand side. That happened before we really got into a bad bear market. You can see the market was coming down, it was crashing down. The stock came down with it, just like all stocks did. We're not really concerned about that because at this point, it's long enough away that anyone who is stuck in that stock, they're probably not in it anymore. And that's really our concern with overhead supply. The concept there is people waiting to get back to even, and they're going to start selling their shares as they get back up to the $155 or $150 range. We're not concerned about that. It was over a year and a half ago. Those people have probably been worn out at this point. So it's one of the things to keep in mind when you have overhead supply. If it's recent, you want to be worried about it. If it's a year and 3/4, year and a half away, it's not as relevant. If it's further away than that, you don't really even want to think about it at all. So let's look at what was happening here. You broke out of this cup with handle. The cup with handle really wasn't ideal. It didn't have what I call a scoop. And a scoop just means a lot of area on the bottom that's really kind of rounding out. This was really kind of more back and forth. You can see it as it went from $98.66 down to $79. That kind of happened in a straight line with one of those just falling straight down. Then you bounced up a little bit, came back down again. That was fine to be putting that work in there. A more classic cup is going to feel more like a U-shaped rather than just some sideways action. So honestly, it's not the best looking cup. You can see that original pivot there, but you could also look at it as a little higher handle, buying it several weeks later. And as it breaks out of either one of those, you can see that it just stops, doesn't get anywhere, and it holds in tight. That's ideal. That's the type of action you'd like to see because the stock has moved up, it's not giving any ground, and people are in there, they're now comfortable with this new price level. You can notice how the spreads, those 2 weeks, they're very small. We like to see that. We don't have to see that. But the closes are almost unchanged for each week. The first week is a big up week. The next week is just up a little tiny bit, and then you get a little red week in there. That's a perfect looking 3 weeks type pattern. Then it moves up for a couple weeks, and you see a 4 weeks type form. This is a nice trading stock. When something does that type of move, it's holding in, it's constructive. This is a relatively liquid name, institutional quality name, and a name that people could really understand because you could go in the stores. Remember, there was always a huge line whenever I'd go in to get a burrito. It gives you a comfort level. It's a lot easier to buy a restaurant stock or a retail stock than it is to go and buy a semiconductor or a biotech that's a little bit harder to understand. So that gives you a little bit of an edge with a name like this, especially if you like their food. Gives you a little more comfort level. So what we're going to do is identify it on a weekly chart, then look at a daily chart to see where exactly we're going to buy. All right, so let's take a look at the daily chart. You can see that cup with handle that it traced out. It broke out. And it runs up to 102.90. It's holding in there tight. And it doesn't really give you a downtrend line that you can draw, but you do kind of have a little bit of an early jump in as you clear the resistance over the last couple weeks. You don't have to wait for it to go into absolute new high ground at 102.90. Earlier in that day, as it was moving into new high ground, you could start your buying and then accelerate your buying as it goes into new high ground there, right around $103. Then you can see it moves up for a few weeks, then holds in tight for 4 weeks. The second buy is pretty much identical to the first one. Right before it starts getting into new high ground, you can see that it's probably going to break out of this 4 weeks tight area, and you start buying it. If you want, you don't even have to start early on the second buy. You can just wait until you get into new high ground and start adding to your position there. Now, on the second round of buying, you're going to buy a little bit less than the first one. So let's back up to the beginning. If you were buying 1,000 shares as it was breaking out of the cup with handle, on the first 3 weeks tight, you might buy 300 or 400 shares. And then on this 4 weeks tight, you might just add 100 or 200 shares. You're always watching your cost basis. You don't want to buy too many shares as it's too high because that's going to ruin your average cost basis. So that was CMG, and that was a beautiful trading stock. Next up is Green Mountain Coffee Roasters, GMCR. This was kind of a squirrely stock to trade. It was not always the most liquid trading stock, but it had an enormous move, and it was a really neat device. It was a new way of brewing coffee. Early on in the move, I wanted to see, was this for real? I went out and bought one, and it was great. always saved me a ton of time in the morning. I didn't have to grind my coffee beans, waking up the kids in the morning. So it was a neat, nifty new idea and something you want to keep an eye out for. When something new comes along, go get the product, try it out, see if it's for real. It's going to give you a little bit more conviction holding the stock. And as I said, this was not an easy stock to hold, just the way it would trade based on a daily chart. The intraday swings were kind of wide all the time. So you really want to know and understand what it is you're looking at. We're going to start looking at this really in the middle of its move. So you can see over on the left side, it ran from $10 up to about $28, then started base building, going a little bit higher, but really not anything that you'd make any money with. You'd get in, you'd get kicked out. Then eventually it formed this kind of deep cup with handle, broke out, and then holds in for 3 weeks tight. That's where we're going to pick this up. So you can see why it's critical that we're looking at a weekly chart to see the 3 weeks tight. There's really no other way to do it. So you always want to start off there. All right, so as you break out of that cup with handle, your run is really 4 weeks, although you have 6 weeks in a row that are up, that are blue. That's really constructive. We've noticed studying our models that if you have 5 or more weeks in the beginning of a move, that's something that happens in a lot of our models, so it's something you want to look for. Doesn't mean the stock is going to work out, but that's kind of how we operate. We see what happened in our model stocks, and we're always on the watch when we're looking at something. The way we interpret 5 or more weeks up in a row is that the big mutual funds and the hedge funds, they're establishing their position. They can't buy their full position in one day. So they're giving their orders to their trading desks and saying, buy 5% of the volume throughout the day, get as many shares as you can, start off with 200,000, and after a few weeks, they've accumulated a few million shares. And with that type of buying that's going on, and if it's not just one fund doing it, it's several funds doing it, it'll drive that price up week after week after week as they're establishing their position. And then what happens here is it just kind of pauses. It's holding in tight. People aren't letting the stock go down. Every time the stock starts to go down, the buyers step in and they're accumulating shares, but they're not aggressive enough to really push the stock higher. So it's just holding in tight as the stock is being accumulated. And notice those weekly closes are almost unchanged. The first week down, the second week in the 3 weeks tight is down a little bit, and then your last week is up. So you're looking at that saying, this is under accumulation. Let's move over to a daily chart and see exactly where we're going to buy it. So we've studied the weekly chart. We've identified that it's under accumulation. We can clearly see that it's 3 weeks tight. So looking at the daily chart of Green Mountain, the way it trades isn't really ideal. It's kind of volatile, and many days you would expect it to move higher the next day, but it ends up falling. For example, on a day where it hits a high of 28.59, your expectation is that the very next day it should move higher, maybe over $30 or close to $30. But instead, you have this little inside day where the high and the low is contained within the high and the low of the prior day. It's not necessarily bad action. It's just not what you would expect. So when you're looking at the chart, you're taking that into consideration and realizing, you know what, I really like this product. It's very interesting, but it doesn't trade on a daily chart in a way that I would really expect. So I'm going to focus more on the weekly chart and maybe not pyramid as heavily into the stock or get too crazy with it because I don't know exactly what to expect, but you don't want to pass up the stock either. So this is one of those things to keep in mind. So let's focus on the 3 weeks tight and exactly where you'd be buying it. As the stock moves through the $30 price range and gets into the mid-30s, you can see on the daily chart, it doesn't look like it's 3 weeks tight at all, but over on the weekly, it was 3 weeks tight. Let's look and see where we would be getting in on this 3 weeks tight. You can see the nice uptrend that it has as it moves through the $30 price range. Again, the context of what we're looking at is the daily chart action is not ideal. We want to focus on the weekly chart. So we're only looking at this daily chart to see where is our entry point. So since we don't have a downtrend that we can draw, it's really an uptrend, we just have to wait until it's clearing into new high ground. So 2 days before that gap up, that's establishing your buy point. So you're buying it there. It makes it really hard to hold the next day because it's closing near the lows. But again, the context was looking at that weekly chart. We've bought those shares. We're not happy about it, but we're not selling it yet. And then you get a big earnings announcement, a big gap up, and the stock has moved higher. If for some reason you've sold any of your shares there, maybe not all of them, but maybe you trimmed back a little bit, you'd be buying those shares back up on the gap up. A clear uptrend has resumed and the stock is moving higher. And whenever earnings are out and they're behind you, a lot of risk is off the table because you're not going to have another earnings announcement for another 13 weeks or so. So once the earnings are out and they've either gapped up or gapped down, you really know how to handle it. If you've got a huge gap down, you've got to exit the trade. And if you've got a gap up, you're just looking to increase your position. So that was Green Mountain back in 2009, and that was a really powerful move up. Not the easiest one to hold, but there was a lot of money to be made in Green Mountain.